Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone, and welcome to the deep dive.
Great to be here.
Today we're diving into a really interesting set of financial headlines. Our mission, well, it's to cut through the noise, basically, bring you the crucial insights, what these stories actually mean for you and the broader economic landscape.
That's right. And we've got quite a mix today, a diverse range of sources, everything from specific company stock reports to, well, deeper analyses of economic trends, international trade shifts.
Yeah, it's a lot to unpack.
It is. It's a complex picture, but hopefully we can help make sense of it all.
Absolutely. And looking through them, what really jumps out is just how interconnected everything is. We're seeing technology, global trade, the sort of overall health of the world economy. They're all feeding into each other in pretty significant ways.
Yeah, you pull one thread.
Exactly. Okay, so let's start with this first big story. It's about NVIDIA and some new trade restrictions.
Right. So our first source here is a MarketWatch article. The headline is, Alibaba stock is falling, and the development at NVIDIA could be the reason.
Okay.
And this piece details how NVIDIA has disclosed new limitations from the U.S. government on its sales to China.
New limits? What specifically?
Well, specifically, they now need a license to export their H20 chips. And it's important to remember, these H20s, they were already a modified version.
Right. They'd already been downgraded to try and comply with the existing rules, so this is tighter still.
Exactly. A further tightening.
And the immediate financial hit for NVIDIA, MarketWatch mentioned that. It sounded pretty big.
Oh, it's significant, yeah. They reported a $5.5 billion charge.
Wow.
Yeah, basically writing down their H20 chip inventory, adjusting customer contracts. It's a hefty price tag.
5.5 billion. Okay, so what does that signal beyond just, a hit to NVIDIA's bottom line? There's more to it, Charlie.
Oh, absolutely. That's the crucial question, isn't it? Beyond the financials for NVIDIA, this really signals an escalation, a real one. In the tech trade tensions between the U.S. and China, this kind of move, it's not just about one company's chips. It forces you to think about the broader strategic game. Like, will this just push China faster towards self-sufficiency?
In things like advanced semiconductors.
Precisely. It's like watching a geopolitical chess match play out, but in the tech sector.
And it's not happening in a vacuum either. That MarketWatch article quotes a Baird analyst, Colin Sebastian, and he points out that Alibaba's cloud division, AliCloud, is probably a major customer for these exact H20 chips.
Right, which makes sense.
So this new license rule, it could really put a damper on AliCloud's growth, couldn't it? And their plans in, generative AI?
Exactly. Think about generative AI, the tech behind advanced chatbots, image creation, all that stuff.
Yeah.
For a cloud business like AliCloud, having access to powerful chips like NVIDIA's, it's essential for developing those services, improving them.
So these restrictions directly hinder them, their ability to innovate, to compete in that space.
Absolutely. It's a rapidly evolving field, and this is a roadblock.
The analyst also mentioned something about DeepSeek, a Chinese AI model.
Yes, the combination of DeepSeek and these H20 chips. It was seen as a really compelling setup for AI development inside China.
Okay.
And the U.S. government's concern, or at least what the article suggests, is about the potential use of this tech in restricted supercomputers.
Ah, so it's that national security versus commercial interest tightrope again.
Always. And what's fascinating is thinking about China's response.
Yeah, what will they do?
Well, as MarketWatch points out, this probably just ramps up the urgency inside China, even more pressure to develop their own domestic alternative.
To NVIDIA, to AMD, these high-end GPUs.
Exactly. They can't really afford long-term dependency on foreign tech in such a critical area. Strategically vital.
It is interesting, though, that analysts, despite this cloud business hurdle for Alibaba, they kept an outperform rating on the stock, and the stock's still up quite a bit this year.
That's a really good point. It shows how complex it is evaluating these huge, diversified companies, doesn't it?
Yeah, one division takes a hit, but the whole ship doesn't necessarily sink.
Exactly. Or maybe the market thinks Alibaba has other growth paths, or perhaps the full long-term impact just isn't priced in yet. Who knows?
And speaking of NVIDIA and China, there was another MarketWatch piece. Jensen Huang is visiting China. The NVIDIA CEO is caught in a trade war.
Right, the timing on that.
Yeah, his trip was just 2 days after these new export curbs were announced. Talk about timing.
Walking right into it. It really underlines the high stakes,
Definitely.
Jensen Huang himself, reportedly, called China a key market for NVIDIA. You could almost feel the tension. A crucial market facing new restrictions, and the CEO is right there, on the ground.
Trying to navigate it all. The article mentioned China officially makes up about, what, 13% of NVIDIA's revenue last fiscal year?
That's the official number, yes.
Yeah.
But it also hints that potentially more revenue might be going through Singapore first,
Ah, okay.
and then ending up in China anyway. So their actual reliance could be, well, even higher than that 13% suggests.
That's a critical detail. Makes the potential impact of these restrictions seem even wider, potentially.
It does. These supply chains, they can be complex, hard to track the final destination sometimes.
And the market certainly noticed all this. NVIDIA stock.
Yeah,
It's had a rough year already, hasn't it?
it has.
And this news just sent it down further on Wednesday. It really shows how sensitive the market is to these trade things, especially with the big tech players.
Definitely. Okay, so shifting gears slightly. Moving from just NVIDIA to maybe the broader tech scene, another MarketWatch article. Intel's earnings could benefit from the tariff frenzy for now. Here's the risk ahead.
Okay, wait. Intel could benefit. How does that work? That seems counterintuitive.
Yeah, it does sound a bit paradoxical, right? But
Yeah.
the idea is this. Intel's next earnings report might actually show a temporary boost
Oh.
because their customers think PC makers mostly are apparently stockpiling chips, PC chips,
Yeah.
in anticipation of potential tariffs
Yeah.
from the Trump administration. The logic is, buy now, build up inventory before prices potentially go up because of tariffs.
Oh, okay. Get ahead of the price hikes. But the analyst in the article warns about that, right? Sounds like pulling demand forward.
Exactly. That's the risk. Once those stockpiles are full, boom, orders could drop off significantly.
Leading to weaker guidance from Intel for, say, the second quarter. Short-term gain, potential long-term pain.
Precisely. And the article uses data from IDC, the market research firm, showing PC shipments were actually up in the first quarter. And they specifically say a big chunk of that was vendors and end users speeding up deliveries. Why? To get ahead of potential tariff.
It's a direct reaction to the uncertainty from trade policy.
Totally.
It's almost the reverse of the pandemic supply chain mess, isn't it? Back then, shortages. Now, potential oversupply driven by tariff fears.
Exactly. The analyst even used the phrase sudden glut of tech gear. A stark contrast, like you said, really shows how disruptive these policies can be for market dynamics.
Absolutely. And this feeds into the bigger picture, doesn't it? These micro reactions in tech, they connect to the broader economic effects of tariffs and this sticky inflation we keep hearing about.
Yes, perfectly linked. Which brings us to a Bloomberg piece featuring the Carlyle CEO, Harvey Schwartz. Title is Carlyle CEO Harvey Schwartz says stickiness of inflation reflects strong economy.
Okay, so Schwartz sees sticky inflation not as a disaster, but as a sign of a strong economy. Maybe it's too early to call a recession. That's optimistic.
It is an optimistic take. His argument is that looking across Carlyle's portfolio, which is pretty diverse, the fact inflation is sticking around suggests the economy is fundamentally resilient.
Interesting.
And interestingly, he also echoes the point about Intel. He sees consumers and businesses doing this front-loading thing.
It's accelerating activity.
Yeah, trying to get ahead of tariff uncertainty, which makes for a strong first quarter, activity-wise.
But injects a whole lot of uncertainty for the rest of the year.
Exactly. And he does voice that concern, too, that these policy decisions might end up slowing business activity even while prices stay high.
Right, that's the tough spot. Stagnant growth, but still high inflation. Stagflation fears, basically.
Which leads us right to Fed Chair Jerome Powell. Another Bloomberg article, Fed's Powell says strong labor market depends on price stability.
Okay, so Powell's message is clear. The Fed is focused on stopping tariffs from causing a sustained rise in inflation.
Very clear. He's essentially saying, look, stable prices are the foundation. They're a prerequisite for a strong labor market in the long run.
He doesn't want these tariff bumps to get baked into the economy.
Precisely. And Bloomberg notes, Powell expects both unemployment and inflation to move away from the Fed's targets for the rest of the year.
Uh-oh.
Yeah. He even acknowledges the potential for the Fed's dual mandate goals, maximum employment and stable prices, to actually come into conflict here.
That's a tricky balancing act. And this hawkish talk from Powell, it's hitting the bond market. There's another Bloomberg piece on that, right? U.S. Treasuries decline as Powell's hawkish message sinks in.
Yep, hitting it directly. Treasury prices fell. Why? Because investors heard Powell loud and clear. Inflation is priority number one.
Okay.
So yields went up, and maybe more importantly, the market started pricing out some of those expected Fed rate cuts for this year.
So Fewer cuts expected now. The market's
They're
listening.
definitely adjusting expectations. And that article also mentioned a view from RBC Blue Bay Asset Management, suggesting U.S. inflation could potentially hit 4%.
4%. Wow. Due to tariffs and a weaker dollar combined.
That's the suggestion. It really highlights how this mix of trade and monetary policy could seriously impact inflation.
Which brings us nicely to market stability, or maybe the lack thereof. A Wall Street Journal article titled, "The Post-COVID Era of Ultra-Calm Markets is Over." Seems about right.
Yeah, you can say that again. Those relatively smooth sailing days after the initial COVID bounce, they seem long gone.
And the WSJ argues Trump's trade policies are a major reason why. Ending that calm, leading to the declines and the volatility we're seeing now.
That's the core argument. We've seen big drops in the major U.S. indexes this year. The NASDAQ even hit bear market territory briefly. And the WSJ points to the wild swings in the VIX Wall Street's fear gauge
Right.
and record trading volumes. All signs point to, well, heightened anxiety.
Jitters.
And the worry among analysts, according to the piece, is that tariffs could, do both bad things at once, fuel inflation and slow growth.
The dreaded stagflation scenario again?
Yeah. Makes it really tough for investors.
Yeah, that's right.
Forces them to rethink strategies, how much risk they want. The old playbook might not work.
No, it might not. And digging into that volatility more, there's a MarketWatch article with VIX echoing 2022 turmoil. Here's a new theory on when Trump will change course.
Okay, VIX echoing 2022. What's the connection?
It points out the VIX has closed above 30 for the longest stretch since October 2022.
Which was another pretty turbulent time. Fed hikes, lots of uncertainty then too. Exactly. So similar levels of market stress.
And the theory about Trump changing course, that sounded unusual.
It is certainly unconventional. The theory posits that Trump might only really shift on tariffs when the VIX, the fear gauge, actually goes higher than his poll approval rating.
Wow. That's viewing economic policy through a very political lens.
It is. But it shows how tangled politics and economics can get, right?
Yeah, no kidding. The article also mentioned an analyst expecting S&P 500 earnings estimates to drop by July because of all this policy uncertainty.
That's the expectation. Just too much uncertainty swirling around, driven by these policy headlines. It makes forecasting earnings really difficult.
And there was something about PE ratios and credit default swaps. Sounded technical.
A bit, yeah. Basically, the S&P 500's price-to-earnings ratio, which measures valuation,
Okay.
and inverted credit default swaps, which can signal short-term risk worries.
Yeah.
Both are apparently pointing towards an uncertain status quo right now. Reinforces that cautious mood.
Got it. Okay, shifting slightly, MarketWatch also had a piece about market seasonality. The day before Good Friday is often a great day for the stock market. Will that be true again this year?
Yes, the old pre-Good Friday rally theory.
Historically, it often is a positive day, right?
Yeah.
But this year, analysts were cautious, given all the tariff volatility.
Understandably cautious.
Yeah.
And sure enough, as MarketWatch reported, Wednesday this week, the day before Good Friday, was actually a down day for markets.
So the historical trend didn't hold.
Nope. Really shows how the current environment is just overriding some of those typical seasonal patterns.
The article talked about why those gains sometimes happen, right? Like traders covering shorts, maybe tax refunds giving people cash.
Yeah, potential reasons like that. But clearly those factors weren't enough to fight the headwinds this year.
And it also mentioned the Monday after Easter weekend often tends to be negative historically. Be interesting to see if that one plays out.
It will. Okay, let's broaden out again. Geopolitics, monetary policy. Bloomberg reported emerging market stocks gain on progress in Japan, U.S. trade talks.
Ah, so a little bit of good news. Even a hint of easing trade tensions helps.
It seems so, especially for emerging markets. President Trump apparently stated there had been big progress in talks with Japan.
So any sign of de-escalation, even with one country, gives sentiment a lift.
Seems that way. But, the article also reminded us about the underlying volatility. Mentions upcoming rate decisions in Turkey and Egypt.
Right.
And those decisions are happening against this backdrop of unpredictable U.S. tariff plans. Highlights how linked everything is: global monetary policy, trade.
Yeah, one country's tariff plan impacts another's rate decision. Crazy. And then there was that quirky Bloomberg piece. German heating oil dealer enjoys record orders after crude drop.
Yeah, that was interesting. An unexpected ripple effect.
So a German online heating oil platform saw orders surge after crude prices dropped following Trump's tariff news.
That's the connection they make. It suggests, maybe some people were speculating, thinking tariffs would slow the global economy, leading to weaker oil demand. So they bought heating oil when crude dipped.
Huh. A very specific local reaction to a global policy issue.
Exactly. Now, switching to the bond market again, there was an opinion piece in MarketWatch. Fund Manager Survey raises questions about Beijing's possible role in bond market turmoil.
Okay, speculation about China and the bond market. What's the puzzle?
Well, the puzzle is bond yields have been rising, which usually means selling pressure.
Right.
But surveys were suggesting fund managers were actually increasing their bond holdings. So yields up, but managers buying. It doesn't quite add up.
Okay, so where does China come in?
Well, the speculation, and it is speculation, is whether China, being a huge holder of U.S. treasuries, might have been quietly selling some off, perhaps in response to U.S. trade policies.
Retaliation, potentially.
Potentially. The article notes a significant jump in the 10-year Treasury yield happened right after Trump announced the latest tariffs. It's not proof, but it raises questions.
Interesting timing for sure. And speaking of U.S.-China financial ties, Bloomberg also reported China stocks face risk of $800 billion U.S. outflows, Goldman says.
Yeah, that paints a stark picture of potential financial decoupling if things really escalate.
$800 billion? That's massive. Goldman thinks U.S. investors might be forced to sell that much in Chinese equities in an extreme scenario.
That's their estimate for an extreme decoupling, yes. And it goes both ways.
How so?
The article also notes Chinese investors might then have to unload their U.S. financial assets, potentially even more, like $1.7 trillion.
Wow. Just shows how deeply intertwined the two financial systems are and how disruptive severing those ties could be.
Absolutely massive disruption potential.
Okay, let's wrap up with a few quick hits on specific companies. The Wall Street Journal. Hertz shares jump 56% as billionaire investor Bill Ackman discloses stake. Huge move.
Massive jump, yeah. Bill Ackman's firm, Pershing Square, taking a big stake. That sent the stock soaring.
And Pershing Square is known for being activist investors, right?
They have that reputation, yes. So this could mean big changes potentially coming for Hertz, especially given their recent meme stock past and EV strategy stumbles.
Right. Okay, on the flip side, MarketWatch reported United Health stock tumbles after earnings missed and outlook slashed. Big drop for a healthcare giant.
Yeah, significant drop there. They lowered their full-year outlook, said it was due to higher care use in their Medicare Advantage business, plus they missed Q1 earnings estimates.
Shows even the big established players face sector pressures.
Definitely. And MarketWatch also noted Microsoft gets a downgrade from KeyBank.
Microsoft. Why?
Concerns about maybe lower cloud demand ahead, and perhaps a slowdown in the AI revolution's pace. Even the tech titans aren't immune to growth worries.
True. And sticking with policy impacting key figures, MarketWatch again. Trump says Powell termination can't come fast enough. The market for Powell firing increases a little.
Yeah, that brings up the whole Fed independence issue again, doesn't it?
President Trump publicly criticizing Powell, suggesting his removal, plus the betting odds on that ticking up slightly. It just adds another layer of uncertainty, doesn't it? Worries about political pressure on the Fed.
It certainly does. Okay, one last one. The Wall Street Journal on what the weak dollar means for the global economy. The dollar weakening has been a bit unexpected.
Yeah, and it has big implications. It seems like it's hitting overseas exporters twice, almost, compounding tariff losses and pressuring their central banks to cut rates.
That's the dynamic. A weaker dollar means profits earned in the U.S. are worth less back home for foreign companies, and their goods get pricier for Americans.
So companies like Toyota, European luxury brands, they could feel the pinch.
They could, yes. And it's weird, right? You'd think tariffs might weaken other currencies against the dollar.
Yeah.
But instead, investors seem to be selling dollar assets, pushing other currencies up. It's unexpected.
And that could weigh on growth in Europe, UK, Japan, and maybe even lower inflation outside the U.S.
Potentially, yes. It's another complex ripple effect.
Okay, so wrapping this all up, looking back at all these headlines,
Right.
a few key themes really dominate, don't they?
They really do. First, the huge, multifaceted impact of trade policy. Tariffs, especially, affecting tech, driving volatility, shaping the whole economic outlook.
Absolutely. And all this trade tension plus the sticky inflation, it's creating so much uncertainty for everyone, investors, businesses.
And the Fed is stuck in the middle, trying to control inflation in this mess. Then you throw in the weak dollar, adding another twist.
Yeah. It's a picture of a global economy that's not just complex, but changing really fast. And policy decisions seem to be the main driver right now.
Driven significantly by policy, yes. Cascading consequences everywhere you look.
Well, that brings us to the end of today's deep dive into these major financial headlines. We really hope this discussion has helped shed some light, given you a clearer understanding of what's going on and what it might mean.
Hope so. Lots to keep track of.
Definitely. And with that, we'll see you all tomorrow morning with new headlines from major financial magazines.